our goal is to take a piece of land and deliver a great build-to-rent community, and we've built a team that is great at leasing those and managing them.
Welcome to the Fully Funded Show. Whether you're a capital raiser, deal sponsor, fund manager, or LP investor, we've got the insights you need for investing success. Join Sam Silverman each week for expert interviews, insider tips, and strategies to fully fund your ventures. Let's go!
All right, we are back with the Fully Funded Show, this time with Ryan Watts of Red River Development. Ryan, thanks for coming on.
Hey, Sam. Good to be with you.
Yeah, so why don't you give the listeners some background on yourself, what your business looks like today, and kind of how you got there as well?
Yeah, happy to. So I co-founded Red River Development in March of 2020, and I did that alongside two partners. One of those partners is Jay Dempsey. Jay's got an extensive background in senior living, has built a big senior living business called Civitas Senior Living. Still a large senior living operator. And they've done a ton of nearly $1 billion in ground up development. And then my other partner is Stephen Watts, share the same last name. So yeah, we're brothers. And he has a background in construction and project management and multifamily development. And so back in, call it 2018, 2019, Stephen was doing some development projects in Oklahoma, Tulsa, Oklahoma, where we all grew up. And Jay and I were investing in those projects. And kind of during that same time period, we were talking about build to rent as an asset class and feeling like that was a fast emerging kind of subsegment within multifamily and something we really believed in and wanted to invest behind. And so I sold a business. I'd previously been in the oil and gas business and sold an oil and gas investment firm in 2020. And that kind of freed me up to spend more time to really focus on building this business. And so fast forward to today, we've got nearly 500 million AUM, about 1,500 units under management. We've built a BTR brand called Trulo Homes. So if you Google, it's TRULO. If you Google Trulo Homes, you'll find our BTR communities. And we do manage those ourselves. So we think that's an important part of the picture for us in terms of being able to have that operational control. And we've got BTR communities today in Tulsa, Oklahoma, Oklahoma City, Bentonville, Arkansas, Kansas City, and Indianapolis, and then have a few deals in the pipeline that we're working on as well.
Cool. And before we dive into the whole BTR as an asset class and senior living as an asset class, which I'm definitely interested in, let's talk about what it's like working with your brother. I think that's something that people, there's always interest there of working with family, working with close friends, working with relatives. Like, how'd that come about, and kind of what's that experience like? And, what learnings have you had for someone who's maybe listening that is considering working with a spouse or a brother or a relative, right? Like, I'm sure you've had a lot of learnings along the way.
Yeah, sure. No, it's been fun, man. I mean, for me, it's been a little bit of a realization of a lifelong dream. We've talked forever about trying to be in business together, and we both were doing different things. And I mentioned that, I was previously had a business that I started that it was focused in the oil and gas space. And so it just really never timed up, but it was always something that we would talk about from time to time, and kind of in the back of my mind was something I wanted to do at some point. And so the stars aligned in 2020, and it's been great. And I previously I've been in business with other family members, and didn't go as well. So I think what Steve and I have is probably complementary skill sets. We do different things, and he lives in Tulsa, so we have an office, a Red River office in Tulsa, where primarily our kind of construction, development, project management folks sit, as well as our property management business is headquartered there. So that's where he spends his time primarily on the business, and I spend it more on capital and new business opportunities, new deals. So that's kind of how we divide and conquer. And we run out of Dallas, where I'm in our Dallas office today. We run kind of our finance and accounting teams out of here too. So that's kind of how we're split up. And yeah, it's been great. I mean, you definitely have working with your brother. You have a level of trust there because there's so much relationship having grown up together, that if it's the right fit from a skill set standpoint and kind of what each is bringing to the table, I think it can work great, and it certainly has in our case.
Very cool. And kind of so for someone who's starting out, kind of looking at that relationship, like what things would you put in place ahead of time? What kind of guardrails would you put in place or kind of think about there as well before partnership, now that you're, a handful of years in and it seems to have gone pretty well?
Yeah. Yeah. I mean, I think it's probably just having, a lot of big picture conversations about the business and about who's doing what, and understanding, each other in terms of, hey, what are you looking to build? Whatever the opportunity is, that, what do you want out of this business? What are you trying to create? What's your tolerance for risk? And does that line up? All of those things are important. And then, yeah, who's doing what? Obviously, some of those conversations are more tactical, but I think it's important to try to understand that, because look, ultimately, both people need to contribute, right? And ideally, they would be contributing in different ways, because if they're stepping on top of each other all the time, it could be tougher.
For sure. And I kind of want to pivot now, looking at the business you built in the oil and gas space. Could you walk me
Yeah.
through kind of, how you built it, what it was, and why you chose to go move on from that?
Yeah. Happy to. So I graduated from the University of Oklahoma and got a degree in energy management, which is an oil and gas focused business degree. I went to work for a big exploration production company in Oklahoma City called Chesapeake Energy. Still around today. They're a large public company, primarily a natural gas producer today. But yeah, enjoyed that industry, and I jumped off pretty early and had the opportunity to start a business back in 2006, and that was an oil and gas focused business that was centered around the Barnett Shale, which was a natural gas field that is in and around Fort Worth. That's kind of what brought me to Dallas. And initially, the business plan, we were just aggregating Barnett Shale leases, so that was the early days of kind of horizontal drilling, fracking, and the Barnett Shale was one of the first places where that technology got applied, and there was a lot of demand at that time. In some ways, analogous to kind of a real estate land rush, but everybody was clamoring all over to get leasehold and acreage to be able to go drill oil and gas wells, natural gas wells in this case. And so we packaged up and sold a bunch of leases. We built field offices in and around the Barnett Shale, had a team of guys that were buying leases and selling those to companies like Chesapeake and XTO. We sold it to Carrizo, a public oil and gas company, and some other private equity backed companies. So that was the first business model. We pivoted once all that gas production came online. Gas prices collapsed in 2008, and so we pivoted to a strategy where we were aggregating oil and gas minerals. So paying a lump sum of cash to an individual landowner to buy out their mineral interest and to step into that income stream, that royalty income stream. And so we put a portfolio of those assets together through a sequence of partnerships. And so I raised initially smaller partnerships, did a $16 million fund, an $18 million fund, then raised some institutional capital from a large energy-focused private equity firm, and then also some institutional investors, endowments, foundations, pensions, guys like that, and put together a large portfolio of oil and gas royalties in multiple areas across the country, but the West Texas Permian Basin, had the Haynesville Shale in North Louisiana, assets in Oklahoma, also in North Dakota, and what's called the Bakken formation. So a lot of put a big portfolio together, and then ultimately exited that to a public royalty company in 2020.
Got it. And so kind of like with that pivot, why go into build to rent, right? Kind of why start looking at real estate if you had so much success in one given field? It's going to help me understand why you decided to go, hey, we see this as an opportunity to go, shift focus going forward.
Yeah, sure. There's kind of a two-pronged answer to that. The first being kind of what we touched on earlier, which was the idea that I'd always wanted to do a business with Steven and also with Jay, and the idea that the people you're partnered with, and kind of as you think about what do you really want to do long term, spend a lot of time building a business, right? And you spend a lot of time with those people. And as I was I really had my head down for 15 years, building the business. It was called Springbok Energy, at least the most recent iteration of that business was Springbok Energy. And so, spend a lot of time building that business, but you're kind of on the treadmill and you're working all the time and just head down focused on it. And so 2020 combined with, effectively selling all of our assets and you're in the heart of COVID, right? And you just got a lot of time to think about the world shut down. If you think back to that time, what do you want to do, right? What's important? What do you want to do long term? And I've always been interested in real estate. I was buying rental property when I was in college and would manage those properties myself and as just a small time landlord. And I've always loved real estate. And in investing with Steven, just sort of seeing the opportunity that was there in build to rent, I thought it was a unique asset class and something we could really build a business around. And then had a lot of confidence in my partners too, right? And Steven and Jay. Both been very successful and felt like we could build a great business. And so ultimately that's just kind of where my heart was, I think. And what really motivated me to want to make that change. I like the oil and gas business. There's a ton of great people in it. And I worked with a lot of those people in the business that I built, but the stars just kind of aligned and ultimately felt like this was where I wanted to take it. And I haven't looked back. It's been great.
Walking through kind of the economics and like business plan around build to rent, right? I'm sure people, I don't think we actually had a guest in the show just yet who focuses on build to rent as their main focus. We're going to walk you through, how all that works.
Yeah, sure. So for us, we are, we're acquiring raw land and, putting that under contract. And then we're doing the design work, and we work with architecture firms and civil engineering firms to design our communities. And with Trulo Homes, we're really trying to give our resident the best of both worlds between a suburban rental home and the amenities of a Class A new built apartment community. That's the product that we're delivering with Trulo. And so, number one, it starts with finding great sites, and we have, certain acquisition criteria that we look at across a bunch of different demographic factors to identify, what we think a great site is in a given market that we've chosen to invest in. And then we got to go, to the city or the municipality to get, our zoning in line. And then it's about, sourcing the capital to develop the project, really, both equity and debt. Market or the total capitalization for most of these projects for us is in the $50 to $60 million range, total capitalization per project. And so, we've worked with a lot of larger, kind of more institutional investors, and I would say, kind of large family office and real estate private equity. But we definitely saw a lot of those guys. When the rates came up, things tightened up a little bit, and development people were looking, I'd say on the institutional side, looking more for kind of buying below replacement cost, trying to find distress in the market. And so we've kind of broadened and diversified our investor base, and my partner Jay and I have raised a lot of capital previously from direct investors and family offices and RA firms and so forth. And so we pivoted there, and but yeah, that our goal is to take a piece of land and deliver a great built to rent community, and we've built a team that is great at leasing those and managing them, and then the typical business plan is a 5-year hold. So we build it, we lease it up. We'll either refi it once we hit stabilization, or we could look to take it to market, depending on the circumstance and kind of the market conditions that exist at that point. But if we continue to hold it, we'll work to grow NOI and then look to exit at the end of year 5. So and we would look from a return profile. You're looking at net returns in the mid to low 20s and kind of 2x multiples at the end of 5 years, and those could the IRRs could push higher and the multiples maybe drop a touch. If we sold quicker.
So when you look at the kind of building out like a build-to-rent community,
yeah,
all I think of is just horizontal apartments, right? So like walk us through like actually like what goes into a community. So I know you mentioned, really nice amenities, right? Kind of going to compete with a typical Class A type building. Like how big are the homes you're putting on there? How spaced out are they? Like walking
yeah.
through more of like what the picture of them actually looks like, because I'm not too familiar with it myself at all.
Yeah, sure. So our communities typically have around 200 homes, and from an amenity set, we've got a large clubhouse, usually 6,000 square foot clubhouse, large 24-hour fitness center there, resort style pool. There's entertainment spaces in the community center for residents, off coffee bar. You've got kind of a little bit of workspace as well for folks that may be working from home. And then we've got green spaces, dog parks, sometimes playgrounds for children, bocce ball, things like that, as amenities. They're gated communities, definitely Class A communities. Inside, you've got high end finishes, typically 10-foot ceilings. Each home has their own private backyard, which is important for our residents, and they're single story detached homes, and they're built in clusters, so the density is about 10, 11 homes to the acre, but it really does give folks a great experience, something that lives more like a home, but has the amenities again of a nice Class A apartment community.
And when you look at like rents in the area relative to Class A apartments, like where are they coming at? Right. So for a comparable product in a Class A apartment building, is it less, more, even? Like what does it look like pricing wise?
Yeah, we're usually going to price at about, and it varies, but let's say a 20 to 40% premium over new built Class A multifamily communities.
Got it. And then are you guys seeing like absorption issues with that pricing, or are you guys seeing them get absorbed really quickly? Like what does that look like in terms of the demand typically for something like this, like throughout the lease up process?
Yeah, we've been ahead of pro forma on lease up, so we've seen strong demand for the product type. It's just there's you saw this get developed a lot in Phoenix, and it's been developed a good bit in Dallas, Austin. Some of the real hot, high growth markets, but we've been a fast mover or first mover in what we think are strong secondary markets, like the ones I mentioned earlier. Kansas City, Indianapolis, Bentonville, Arkansas. And they've not seen as much development of this product there. And so there's a little bit of market kind of education about what it is. But I think once people see it and understand it, they really love it. And, there's a lot of strong kind of drivers there as you look at interest rates and kind of the lack of home affordability. Average principal and interest payment for a medium priced home in the U.S. is close to $2,900 a month. And it doesn't even include, the cost of insurance and property taxes and all the other carrying costs that you've got with a home, maintenance. So our rents are usually around $2 a foot, give or take. Can be a little more, but depending on the area. But that leads to chunk rents in close to the $2,000 a month range or more. So that's a pretty good value proposition for a lot of our residents that may not be ready to buy a house yet, but they want something that lives more like a home, right? They've been living in an apartment. They want something that feels more like a home. Or on the other end, we see a lot of empty nesters and folks that have maybe raised a family in a suburban community. They don't need the big house anymore, and this is a great fit for those folks as well.
Yeah, I saw something similar too. If you look at, I think the latest James Ang report, I think they're saying the average mortgage right now is about $2,900, $3,000. So the average rent is more about $1,800 range. So for you, I believe you can kind of slide between those two numbers from looking at still offering a home type structure, but at a lesser price point in terms of your monthly costs. So
yeah,
on your end, like, how do you see the impact of rates potentially coming down when looking at affordability and the mortgage side of it, right? With what the Fed's doing, with the potential downward pressure on treasuries, right? how do you see that impacting the demand and supply for the kind of built to rent communities?
Yeah, yeah. I still think we're in the very early innings of the built to rent space. There's a lot more room to develop this product and to bring it to a lot of the markets that we're in and others. As rates come down, look, there's been a lot of inflation that run up, right? That's occurred, and so the rate of growth has slowed, but the value of homes has gone way up, and while it's not growing in double digits anymore, it's still considerably higher than where it was if you look back, 5, 7 years ago. So I don't think the home affordability issues change a lot in the near term. Now interest rates coming down will ease just the average monthly payment a little bit, but that gap that I mentioned earlier is still a pretty big one when you think about $2,900 a month median price home today, plus talking about add in property taxes, add in all the carrying costs, the maintenance, the insurance. There's still a big gap there, even if you see it ease up a couple $100 a month on the P&I payment.
And when you kind of look at, I know you mentioned that you work with a lot of like larger institutions for capital, family offices. Like,
Yeah.
how have you gone about building those relationships in terms of getting in front of the right people, right? Work with pension funds potentially as well. Like, help us understand, how you went to go seek out those relationships and ultimately bring them on as capital partners.
Yeah, sure. Well, when we founded the business, I'd say capital was more plentiful. Our big challenges early on were inflation, right, and dealing with materials cost increases and the per unit cost increases of the communities we were building. But capital was plentiful, so I think we did a pretty good job early on, and I would credit my partners as well, Jay especially, who's got a lot of good capital relationships that he built over the years in growing Civitas Senior Living. They've got 38 senior living communities that they operate today, down from 60. So that's a large business. So I think as we got ramped up, I think we were able to leverage a lot of that and connect with institutional investors that were looking to invest in this space. And so we formed some good relationships early on with a couple of key firms and a lot of other firms that maybe we didn't do deals with, but still know them well. And I think at some point those guys, you could see those guys kind of come back in the market. So for me, it's just, you just got to spend the time to build the relationships and, try to get to know people, meet them in person where you can, and do the work that it takes to really, build a relationship. And then once you're partnered with them, you got to execute, right, and be a good partner. And I think we've done that. And so that's, that flywheel just starts turning over time. And the more you lean into it, I think you see the fruits come back.
Yeah, really cool. I mean, it makes a lot of sense, especially right now, the in-person piece of it too. I feel like the things that don't scale definitely play up right now where they may haven't in the past at all, kind of looking at where you double down on your time and effort. So for you and the team, kind of what's next? What are you guys focused on? And kind of what do you guys see for the next few years for yourself as well?
Yeah. So we've got 5 communities, true low communities today, and really 4 of those are still in lease up, and we're leasing those up, and in some cases still building. Our communities in Bentonville and Indianapolis and Kansas City are still under construction, so we're delivering the remaining phases of those homes because we build these communities in phases. And then we have 3 sites that we own today that are kind of future deals in the pipeline, and the next one of those that is coming most quickly is Centerville, Ohio. So that's high-end suburban community in the Cincinnati-Dayton MSA, so kind of halfway between Cincinnati and Dayton. And in the upper Midwest, I mentioned we've got a community in Indianapolis. We're partnered with a group called Leo Brown Group in the upper Midwest, where they build for us there. So they're a large developer, have done primarily seniors, but some multi too, and they're a good partner for us up there. Really give us boots on the ground in the upper Midwest. They've done a great job building our community in Indianapolis, and they'll look to build this community in Centerville, Ohio. So that's the next deal up, and then we've got another deal coming in Waco, Texas, and then another one in Kansas City. So those are the primary focus here now, as we're looking to get those projects capitalized and out of the ground.
Very cool. Well, hey, before we hop off here, how and why should listeners reach out to you?
Sure. Yeah, you can find us online at redriverdevelopment.com. I mentioned Trullo Homes. You can see our communities and a lot of imagery of those communities there. Trullo's more of our resident facing brand or customer facing brand. So yeah, would love to connect with folks. We spent a lot of time working with capital allocators and fund managers as we're looking ahead to our next BTR development opportunity here. So would love to connect with those folks, and feel free to reach out through the website, and would look forward to speaking with you.
Cool. Ryan, thanks for coming on.
Thanks, Sam. I appreciate it.
Thank you for tuning into the Fully Funded Show hosted by Sam Silverman. If you are enjoying the content, let's take your journey further in the Fully Funded Mastermind. The Fully Funded Mastermind offers more than just insights. It's a mastermind community designed to solve the real challenge of raising capital. By joining, you gain direct access to strategies, coaching, and a network dedicated to turning your financial goals into achievements. Don't let capital raising be a barrier to your success. Visit fullyfunded.capital to explore how our mastermind community can pave your way to financial growth.
Thanks for tuning in to the Fully Funded Show. If you enjoyed today's insights, hit follow, share with your investing pals, and drop us a review. Connect with us on social media for bonus content. Your success is our mission. Keep those funds flowing. See you next time.